So in this week's module about cash management, I'd like to start by walking you through where you can find the materials since we're just on week one. And what we're going to be reviewing today is all captured in the week one module. So you've probably already found your way to the materials that are included here, including the pre-readings as well as the videos. And of these videos, I just wanted to place a special emphasis on the banking basics because that's going to form sort of the basis for our discussion around banking and banking products. So if you haven't had a chance to review these videos, and specifically this one, as well as these readings, I'm going to have you pause my recording and just go ahead and dive into those. It shouldn't take you long to get through it. And then when you're done, come on back. All right. So the other thing I wanted to point you to is in the week one modules, I've uploaded the slides for this week's lecture. I'll be going through them. They're on the left side of the screen over here. But in case you want to take notes on them or you just want to have them open while we're going through this material, that's where you can find it. And in fact, after every week's lecture, you will find the lecture slides will be uploaded to that week's module. All right, so let's dive into the slides. So for cash and money attitudes, I think the thing I wanted to emphasize most here is, well, first let's start with money attitudes. This maybe forms one of the more interesting areas of research when it comes to financial planning and helping clients manage their finances, is sort of helping them become aware of and manage their own attitudes around money. In this week's activities, we're not going to focus too heavily on this, but a lot of the readings did go into it. And I would encourage you as you go through this week's course as well as future weeks to sort of pay attention to your own attitudes about money and be thoughtful about where some of those attitudes were formed and which ones you hope to change over time. For many of us, you may have grown up in an environment where money wasn't discussed, and you might not even know what your values are around money, much less what your attitude is. So it might take some time for you to sort of uncover where your biases come from and to identify what's important to you when it comes to your money. Now, when it comes to cash, this is perhaps the most basic form of investing. And many of you indicated that one of your major goals for this course is to understand more about investing. And no discussion around investing is complete without cash. And since it's at the Maslow's level 1 area of investments, that's where we're going to start. And so for the phrase cash is king is used frequently, and I'm going to make this slide just a little bit bigger so you can see the graphic. And in fact, I'll also bring it up online. In investing, you will often see this asset map that shows asset class returns by year. And you'll notice that the same players, at least in this version of the map, are present. So we've got 1, 2, 3, 4, 5, 6, 7, 8. It's showing 9 asset classes, but that's a little bit of a cheat because this is a blend. The AA is a blend it's a blended portfolio, 60% stocks, 40% bonds and cash. But you'll notice in 2018, the winner, and still king, is cash at 2%. So the average return for cash and cash-like assets in 2018 was 2%. You might ask yourself, how the heck did that happen? Well, it was a tough year. At least it was a tough year for stocks and also for bonds for a variety of reasons, which maybe we'll talk about later in this course. But what I want to point out is that you've got several asset classes that are listed here, and cash is on its own. Oftentimes, it's lumped in with bonds because it's also called a fixed income investment. But you can see that the other returns by asset class, everything is at zero or negative for 2018. And there's an index or listing of what each of these asset classes stands for. So the next in line, HG bonds, is high grade bonds, so not junk bonds, broke even. And then high yield bonds, which are technically a little riskier, weren't so high yield, negative 2.3%. REITs, that stands for Real Estate Investment Trust. That's just like a mutual fund full of real estate assets. So if you want to invest in real estate, but you don't want to own an individual apartment building, for example, you can get a piece of the action by owning a share of a real estate investment trust. And they lost 4% last year. Large cap stocks, minus 4.4%. And then that 60-40 portfolio, which is sort of blending all of these together in a special sauce of 60% stocks, 40% bonds, that would have lost 5.6%. Small cap stocks lost 11%. International stock lost 13.4%. And emerging markets lost 14.3%. And as this course progresses, you're going to hear us talk about how difficult it is to figure out who's going to win from one year to the next and who's going to lose. And what's interesting is if you look across this top row, which is indicative of which asset class won each year, you see some commonalities where REITs did really well several years in a row. But then in the years where they didn't do so well, oh my God. I mean, if you thought maybe you could figure out a way to write an algorithm to predict this, please let me know. Many have tried, and many more will attempt it because it's so intoxicating, really, when you look at this map. But I guess the point about cash being king, it's not always going to be number one. It just was for 2018. But when we talk about cash being king, we're not really talking about the return. We're talking about its stability and its liquidity. Because if you look back over the history of what cash has achieved, last year it was at the bottom position, but it still had a positive return of 1%, 0.3, 0.1, etc. Now, these returns, of course, are the actual returns. What they don't tell you is, well, what happens to your buying power if inflation is higher than your rate of return on cash? So that's one of the big downsides of cash, is oftentimes it can't compete. It can't keep pace with inflation. I have lots of clients who love the idea of just staying in cash because they're terrified of the stock market. And so we oftentimes have to figure out a way to structure their cash investments so that at least they'll come close to inflation. But it's not always possible, which is why most of us end up having to put some of our money into stocks, because over the long haul, the expectation is that stocks are the only place that we're going to get enough juice to help combat inflation. So cash is king because of liquidity, and oftentimes because we are able to get guaranteed returns on our investments. So in the various forms of cash, we can talk about actual physical currency and coins, also called legal tender. Now, if you're going to keep this in your pocket, then you're probably not going to get much of a return on it. Although people who have lived a long enough life, or who are students of history, might feel that cash in your pocket or in your house is the safest cash ever in their minds. I don't agree with them, but they feel that that's safe in the event that there's a collapse of the banking system. And many would argue that if the banking system collapses and you've got cash in your house, that's not going to do you much good. You'd need something to barter with instead, but that's a different discussion for another day. So forms of cash, but we can't ignore the fact that actual physical currency is a form. But bank accounts, including savings, checking, money market accounts, and CDs, all four of those products you can buy at almost any bank or open at any bank. And they all offer various benefits. Not all of them are necessarily going to offer you an actual return, however. So, for example, most checking accounts don't offer you any interest on your deposit, but others do. For example, savings accounts offer you some modest amount of interest, especially if you're using a local bank. But I'm going to show you in a minute how some of these internet banks are really crushing it with their savings rates. And then money market accounts are a form of a savings account, but they just have fewer transactions. They're sort of a blend between savings and checking accounts. Checking accounts usually don't have a limit on the number of transactions, and that's why they don't offer you much in the form of interest rates. Whereas money market accounts offer you a better rate, but a limit of usually about 6 transactions a month. They don't really want to deal with all of the administrative hassle. So if you're willing to not be a frequent user of your account, then they'll give you a better rate. And then today's big focus is going to be on CDs, and we're going to go into those in a minute. So other forms of cash outside of a bank account include money market funds. So if you open up a brokerage account at Vanguard or Schwab or TD Ameritrade or any of those places, they will offer you a money market fund. And this is very similar to the kind of money market fund that you're going to get from a bank, only you're going to own it inside of your brokerage account. And this money market fund will be fairly stable, low returning. It won't look like most of your other investments, but it does have the chance to earn some interest. And there are probably other forms of cash that we could dream up or cash-like investments, but these are the main ones that I want to focus on for today's discussion. So finding current rates on those various bank products, it's interesting because they can be very difficult to find and compare on a local basis. So if you want to look at your local banks all in one sort of tool, it's very hard to get at that information. And I have my own theories on why they make it so difficult. And it's really because your local banks know they can't compete with internet banks, because local banks are so appealing to most people. They really like the ability to go in and deal with a human being and the idea of visiting their money, although their money isn't actually in that bank, because as you know from the video that you watched, the moment you make a deposit into a savings or a checking account, that bank is trying desperately to loan it out to somebody else at a much higher rate than they are giving you on your deposit account. So anyhow, it's an illusion that your money is sitting in there. Technically, you can withdraw it from that physical bank, that local bank. You can just show up and hopefully get your money, but there's possibly a limit on how much you can withdraw in any one day. And that's the challenge with internet banks is, it's not like you have this immediate access to your money, especially if you're trying to move large sums and transfer it to your local bank. There are some exceptions to this, but generally, if you have an internet bank and an ATM card, you can withdraw a certain amount per day, but there's limits on how much you can access immediately. And so internet banks tend to scare a certain chunk of the population that's very attracted to cash and cash-like assets. I have a hard time getting my older clients to be comfortable with using an internet bank, but it's becoming easier, and I'll show you why. Let's take a look using NerdWallet, for example, and just see what the interest rates are on savings accounts with some of these internet banks. So today's rates for CIT Bank, 2.45%. I've been noticing that these rates have been creeping up. It's really interesting because the first mover in really going big for a savings account rate was Marcus by Goldman Sachs. But now they've got all this company. Citizens Access was the second mover, and they beat Marcus right away. I'm just now seeing this PurePoint Financial. But you've got a number of online banks that are over 2%, which is spectacular. Now let's look at the bottom of the list. And notice that I asked NerdWallet to tell me about savings accounts in my zip code with a minimum deposit of $10,000, although I bet we could go lower and most of these banks would still show up. And you can see that Wells Fargo, Chase, U.S. Bank, and I've never heard of Huntington Bank. I don't know how they're going to survive with these low interest rates. It's just stunning how low some of these are. And then here's my bank, Associated. I don't have a savings account there, but if I did, I'd be getting 0.05%. That's horrific. So think about it. If you had a really large cash balance And some of my older clients do hang on to a lot of cash. In fact, I have one who just received a large insurance settlement. We got to figure out where we want to invest it. She's a little bit scared of the market, so we're going to park it in cash for a bit. And it's $500,000 worth of cash. And do the math on the difference between staying with, and in fact, she's with UW Credit Union. Let's just go there. We're going to come back to this in a minute. She currently has an account, a money market account at UW Credit Union, and she's earning 0.64%. Awesome. On her $500,000. So if she stays there for a year and gets that interest, 500,000 times 0.0064, that's $3,200. Versus if I can convince her to move it to CIT Bank. Remember, $3,200. She was very excited about that $3,200 in 1 year from UW Credit Union. But if we go to CIT Bank and we take that $500,000 times 0.0245, well, now she's made $12,250, which, quick math, minus $3,200 is $9,000 more. I've more than paid for my fee this year, because I don't charge anywhere near $9,000 a year to my clients. But anyhow, you get the point. If you've got a lot of cash laying around, it pays to hunt for good rates. So where can you find good rates? I've just pulled up NerdWallet. That's one option. You also have, I wanted to pull up bankrate.com is another one. Oh, here it is. So, and then Motley Fool has their own search tool. What I don't like about theirs is it's a little bit more difficult to sort by APY. A lot of the same players show up on these sites. So, but if you go to a local bank site, you can see their rates, and they won't always land on those aggregator sites. And so if you want to check your own local bank for the rates that they are willing to offer, you have to go directly to their website, which is not very efficient. I don't like it at all. All right. So we've talked a little bit about rates and where you find rates for these various products. Now let's talk a little bit about CDs in particular, because CDs are typically the place where you're going to go to earn the highest interest rate on your cash. And so there's a catch. If you are interested in getting that guaranteed rate, because, oh, by the way, these rates that are reflected, let me go back to NerdWallet. This rate that CIT Bank is offering and Citizens Access and Marcus and all these, if you read the fine print, it tells you that they can change that interest rate at any time. So if you are going to be using an internet bank and want to chase rate, you might be moving your money a lot. Now, these guys know this, and they know that they risk losing you the minute they reduce their rate. But they also know that if they stay fairly close together in their rates, they kind of move together, that you're probably not willing to move if you're only going to get an extra, 0.1%. Of course, it depends on how much you have on deposit. So these rates, that's what they're paying today on these savings accounts. But with a CD, and let's just pull up CDs for a moment. Let's see here, banking, CD rates. And ultimately today's assignment is going to be about UW Credit Union CDs. But let's start. Why do they always put me back in California? How I wish. 5, 3, 7, 2, 6. Let's see what they give us for CD rates. And let's say that we are interested, 2-year deposit term is fine, I guess. But in today's worksheet, I think it asks about a 1-year period. And it also asks about, I think, $500. We'll do 1,000. Okay. So here's Goldman Sachs again. They are at the top of the heap for this particular CD flavor. So the difference between a savings account and a money market account, checking account, and a CD is, the main difference is with a CD, the bank says, look, if you leave your money with us for a year. You buy this 1-year CD. This is the rate we will pay you for that whole year. Seems pretty simple. And for a year, sure, you can keep my money for a year. Where people start to get a little twitchy is when, let's say, you want to leave it. You want an even better rate. And in order to get a better rate, you got to be willing to leave it there longer. Because, of course, they love the idea of knowing that you're going to leave your money there. They're going to pay you 3%, but they're going to loan out your same deposit to somebody else for a higher interest rate. So they like this fixed period because they're anticipating. It gives them more stability and the ability to loan more money out at a higher rate. So the difference between a 1-year and a 5-year CD can be pretty significant when it comes to your rate. Anyhow, so that's the guaranteed nature of it. The other benefit of a CD is you're getting that interest rate, and it's also it benefits from FDIC insurance, as opposed to other investments that you might be interested in that don't offer FDIC. It's one of the benefits. So the bottom line with CDs is you're committing your money for a specific period. Because what if you bail? Let's say you say, okay, I'm interested in this 5-year CD. And then in year 4, you're like, I'm out. I can't take this anymore. You're going to give up some of the interest that you earned, as well as possibly a penalty. So you'll get your original investment back as long as you bought it directly from a bank. Brokered CDs are a more exotic animal. We won't talk about them in this class, but just know that they exist. But generally, CDs that you buy directly from a bank, you'll always get your original principal back, but it's the interest that might be subject to forfeiture if you bail early. Let's see if there's any downsides that we want to talk about. Oh, we'll hit on that in a moment. So, the advantages of the CD, again, usually it's the highest available interest rate for any kind of cash investment. The rate's guaranteed. We've got the insurance. Downside, money's off limits, sort of. I mean, you can get the money back. It's just that you're going to give up some of the interest that you've earned and possibly a penalty. And the other risk is that the rate might rise during your CD period. So let's go back to this 5-year CD at American Express. It's at 3.1%. Let's say 2 years into this CD, you could buy a new one that's paying 5% for the same 5-year period. What would you do? Well, you bail, most likely, and you're going to give up some of the interest that you've earned, and you'll have to do the math as to whether or not it's worth it. If the net return for you, given that expense, is going to be worth bailing on your 5-year CD. So that's where people get a little bit twitchy about committing to these longer terms. And oftentimes you'll hear about people laddering CDs so that they can sort of accommodate the potential for higher interest rates in the future. And there's a new flavor of CD out there. And in fact, you'll see it on the UW Credit Union website. And that includes this, what they call a rate bump CD. And the rate bump CD is becoming more popular with internet banks as well, where they will allow you, at least with the UW Credit Union version, it's a 24-month CD. And they say, look, you can have one bump during your 24-month period. So in the event that rates go up while you have your money in this CD, we'll let you reset the rate to whatever the new rate is. They give you one of those during the 24-month period. So they're trying to combat people bailing on the CDs. And they're also trying to attract people to purchase the product who might be afraid of committing their money for that time period because of what they expect to be rate fluctuations. So other disadvantage of a CD is you might make more money somewhere else. As we looked at with that, this chart of returns, maybe instead of having your money in a CD, aka cash, maybe you could do better in a different asset class. The downside, of course, being any other asset class introduces a lot more risk than cash. But cash's biggest risk is inflation. So risk is present no matter what we do. All right, so let's dive into the in-class exercise. and take a look at how a CD works. And the first step to this is going to be to go to the week 1 cash management, in-class activities, download the Word document CD exercise, and once you complete it, you're going to upload it. Back here, you'll click on this. It's not going to show it to me because I'm looking at the instructor version, but that's where you'll upload it. So this is what the worksheet looks like. And it's going to send you to a couple of sites to do your own research on CDs. See if somebody else explains it better than I do. Absolutely, you will find better explanations than I just gave you. But I think the more time you spend sort of absorbing the pros and cons of CDs, the more it's going to sink in. And then in your own words, like you're explaining it to a friend, describe what a CD is. And then come back to the UW Credit Union site and let's take a look at, I'm just going to guide you through this. You're going to go to rates up at the top. And then save and invest. You can also look at loans and credit cards. If you want to see how much they're making, check out the difference between what they're paying on a savings account, which is where most people park their cash, say 0.03%, versus what they're getting in loans. Oh, there's a home construction loan for 2.49%. So that's probably, is that the lowest rate? Oh, here's a variable interest rate home equity loan, new car loans. Anyways, most of these are going to be 3% or more. So you can see that they make a pretty decent sum by loaning your money out. Anyhow, so let's go back to the savings and investing section. The first question is, let's say you're going to deposit $500 into a 12-month CD. Well, remember that CD stands for Certificate of Deposit, and here is the word certificate. And let's read the fine print because there is a footnote. All certificates compounded daily, paid quarterly. Premium checking accounts, you'll notice that there's a different rate if you have a checking account with UW Credit Union, but let's ignore that. Let's go back up to the top and look at all these various CDs that they offer. Here's that rate bump one we talked about before. It's a 24-month term, so 2 years. Have to have $5,000 to open it. Current annual percentage yield is 2.45%, but if you have a $250,000 amount to deposit, you get a little bit of a bump. Hooray. But that's not what the bump refers to. What the bump refers to, remember, is that if rates go up during your holding period and you want to adjust it, you get one per period. All right. This next section called specials. This is where banks like to confuse you. They don't want you to be able to compare apples to apples. So let's say BMO Harris or US Bank has a special CD rate too. They probably are making sure that their versions are a different number of months. So one might be 7 months versus, so they always pick these off months just as a way to make it difficult for you to really price shop. I don't like that, but it's done. So you can see though that these specials, while it's annoying, it's quite profitable to consider them. So this 8-month CD special, 1.64%, minimum $5,000. Now let's go down to, is there another minimum? Oh, they don't show it, but let's just use your regular CDs as a point of comparison. So what's the closest to this 8-month CD? Let's use the 9-month. So a 9-month CD, 0.6%. And if you have $250,000 to invest, they'll jump it up to 0.7. Well, why would anybody buy this 9-month CD right now when you could use this 8-month CD and get a significantly higher rate of return? Anyhow, but that's not what your worksheet's asking about. It wants to know what's the APY for a 12-month CD with a $500 deposit. And let me help you with that. 12-month CD APY. we're ignoring these rates because we're not going to have a $10,000 minimum or a premium checking account or a $250,000 minimum. We're just going to stick with this column. So there's your APY on a 12-month CD. And to figure out what the annual interest rate is, you're going to take the $500 and multiply it times 0.7%. There might be, based on what I just read down here, I'd want to make sure that that was true. Compounded daily, paid quarterly. That's what the APY refers to. That's how, given the interest rate that's being paid on this CD, you are going to get an effective rate of 0.7% after the first 12-month period. So now it asks, let's take a look at what a savings account would accomplish. Well, we've already peeked at that. Let's go all the way down to savings account. The rest of these are not savings accounts. Here we go. Savings. And we're not going to assume it's a college savings. We're just going to assume savings. 0.03%. And then do the same math on what you would earn with that type of account. And then you can maybe reuse some of the bullet points I used on the advantages and disadvantages of CDs, but I encourage you to try to find one that I didn't list because they exist. Anyhow, hope this has been helpful. If you have any questions, please post a comment or go ahead and email me or your peer educator. And